Talk to us a little bit about loan to value and what to expect.
Well, loan to value, if salary is what you're earning, if Europe, it's what we're talking about, 80%, it will be easy to obtain. Banks are being more and more conservative, so they will point in the direction of a 70% loan to value.
Okay.
But if you're coming from South Africa, Brazil, that, as I mentioned, your loan to value will be reduced to 60%.
60%. And talk to us a little bit about the time frame on this. What are we looking at in years usually?
Yes, I think that's a very good question, because most of our clients, they come and they probably prefer to have their companies holding the assets. So real estate owned by companies has only 15 years of mortgage, where on the other hand, if you finance on your personal capacity, you can go all the way to 75 years of age. So I think this makes a complete difference on the time frame and also on the interest rate. So buying through a company is good if your company will be selling it within 3 years. Right. If not, it makes no sense.
It's better to do it through an individual.
It's always better to do it through an individual.
Okay, well, that's very interesting to know. Now, generally, would you recommend a fixed or a variable rate, and what are the differences between the two?
Well, fixed rate is very interesting. We're in Portugal. Fixed rates are on the range of 3%. So it's always interesting. It's a real estate investment. You will make much more onto the capital gains of the property, and definitely you will then are only investing a part of the amount. Anyway, on my personal opinion is that if you are a long-term investor, if you know what you're doing, if you play well your savings, then in that case, I would use variable rate. Because if you take the last 20 years, most of the time the interest rates were under 2%. And only in 2 periods, we're talking about 4 years, they went over 2%. And on the last 10 years, they were under 1%. So a spread of the bank on top of a variable Euribor will be under the 3% mark in most of the time. Obviously, you need to be prepared if the interest rate go up, that you need to pay the difference and you need to be prepared.
Now, can you switch if you have a fixed rate to a variable rate afterwards, or a variable to a fixed afterwards?
That's again, if you have a fixed rate, you cannot change. It will cost you 2% to change to a variable rate. Right. While on the other hand, if you have a variable rate, and you can always change to a fixed rate, and I mean the penalty is 0.5%, but most of the banks will cover that to have you as a client on a fixed rate for a long time. So you
can do that. So you'd rather change variable to fixed.
Variable to fixed, it will most likely be paid by the bank, so you have no costs and you just change. Obviously, also on a variable rate, you can decide to repay your mortgage because the penalty is only 0.5%. While in the fixed rate, you will stick to that because it's 2% penalty, so it's just not so efficient.
We've been hearing a lot about interest rates are rising, inflation is happening, everyone's scared, we shouldn't go to a bank, we shouldn't ask for a mortgage, disaster. This is all we've been hearing. What is your opinion on this? Because I know I have mine.
I believe that you should hear the masters when it comes to a time of conflict, time of uncertainty. So basically, I hear people like Warren Buffett or other gurus of investment. And definitely, if you're very paranoid and then interest rates go up and you decided for a variable rate, but you are not safe or secure, and then you will freak out or just stress, it's just that, yes, the panic is not something you want to do. Real estate is long term. So that's what I said when we were talking about fixed versus variable. If you have your savings in place, you can go for variable. If not, just fix the rate and enjoy the privilege of the capital gains that you will have in the real estate later on. Yeah.